Okay, so sorry I was running a couple of minutes late. I didn't mean to do that, but we're going to start off today with our discussion of implied equity risk premiums. Rather than my tell you what's going to happen to the implied premium as numbers change, here's what I'd like to do. I'd like to take you to my February 2015 implied premium spreadsheet, which I've emailed to you 4 times already, which I'm sure you haven't seen yet. And what I'd like to do actually is take this spreadsheet and ask some very simple what-if questions about what will happen to the equity risk premium if this number changes. So let me give you the setup again. The implied equity risk premium is an internal rate of return. I take the level of the index and the cash flows and back out from it what the equity risk premium is. So this is not what I think, what you think. This is what the market collectively is charging for risk. Start of February 2015, as for every month since September of 2008, I computed that premium for the US. It is about 6.01%. So at the start of this month, the implied premium was about 6. What does that mean? Given how the market is priced, it looks like investors are charging 6.01% over and above the T-bond rate that day to invest in equities. So you ready? I'm going to basically take input by input, and we're going to do something which is very artificial. We're going to change one thing at a time and see what effect it has on the equity risk premium. Okay? So let's start with the equity index. In fact, we can make this real. Does anybody know what the S&P 500 is at right now? It was 1994 at the start of this month. Does anybody know? It's gone up. I don't know by how much because it's hitting record highs. Let's say it's gone up by 10%. It hasn't gone up by that much. But let's say you hold everything else constant and you raise the level of the index. Will the equity risk premium go down, go up, or remain unchanged? Again, remember again, the easiest way to think about this is think about bonds and interest rates, because those are much cleaner to think about, right? When a bond price goes up, what happens to the interest rate on the bond? It goes down. If I hold everything else constant and increase stock prices, the equity risk premium goes down. And the intuition is if you pay more up front for something, are you going to earn a higher return on that investment or lower return? If you pay more up front, you've reduced the return because you paid a lot up front. So the first what if is if the market goes up, equity risk. So this month, equity risk premiums have probably drifted down, holding all else constant because the market is up. Now let's do a second what if. And if you don't believe me, let's try this out. Okay, let's make the index. I don't even know what it is today. Let's make it 2,000. Does anybody have 2,100? 2,100. Wow, that's a nice round number. 2,100. Okay. Now here's how you solve for the implied equity risk premium. You go into data. You look for solver. Okay, and what you're going to solve for is basically. See what this is. See this number right here? You want the intrinsic value to be equal to 2,100. That's what the IRR is by changing this number. So basically, it's like an internal rate of return. Ready? Let's hit it. Let's hit the solve and see what happens. So remember, it's 6.01%. I've now entered 2,100. Let's see what happens to the number. That's 5.72%. You're saying the equity risk can change by 0.28% in 1 month? It just did in 20-something days. That's it because the market went up. Now let's take the second one. Let's keep the index the same, increase cash flows. By now you kind of get the sense of what you need to do. If I have the index unchanged, the cash flows go up by 10%. What's going to happen to the equity risk premium? Same, you say the same price, you get higher cash flows. Are you earning a higher internal rate of return or a lower internal rate of return? You're earning, so equity risk premium is going to go up by some percentage. Now let me ask you a mixed question. If the market goes up 10% and cash flows go up 10%, what happens to the equity risk premium? It stays the same. Now do you see what causes equity risk premiums over time to expand and contract? It's the market moving disproportionately with cash flows. If cash flows go up 20% and the market goes up 50%, the equity risk premium has to come down. If cash flows go up 50%, it's not just looking at the market, it's also looking at cash flows. What if I increase the growth in those cash flows? What's going to happen to my equity risk premium? Same rates. You pay the same price. I give you higher growth. You're getting higher cash flows. Your internal rate of return goes up. Your equity risk premium is going to go up. So market goes up, equity risk premium goes down. Cash flows go up, equity risk premium goes up. Growth rate goes up. And if you don't believe me, go on and play with the spreadsheet. It's the best way to get a sense of what will happen. Last question. If the risk-free rate goes up, I mean, all this talk about the QE ending and interest rates going up. I mean, it's been talked for 5 years. But let's say you believe it now. Let's say you believe the T-bond rate is going to go up to 3.5%. Holding all its constant, what should happen to the equity risk premium? Let's try this, okay? Let's play Janet Yellen gone on steroids for a moment, right? So this is what we're going to do. I'm going to go into that room in the Federal Reserve where she manages interest rates, that lever, and we're going to set interest rates to 3.5%. I'm feeling powerful, right? Let's see now what has to happen. So I'm going to do the same setup. Remember, it was 5.72. Let's see what happens now. Oops, nothing happened. Okay, risk-free rate. There you go. Risk-free rate goes up, equity risk premium comes down. It doesn't come down by as much as you thought it would, right? Because I increased. You know why it didn't come down as much? Remember last session I showed you the relationship between risk-free rates and growth in the long term? So when people bemoan the fact that rates can go up, they're missing the point that that might not be as bad news as people make it out to be, because it's accompanied often with higher growth and your cash flows are affected as well. So if you get a chance, take this spreadsheet and play with it. Play with it, change the index. Because once you get a sense of what drives the equity risk premium, you're starting to get a sense of when stories make sense about stocks and when they don't. And a lot of stories you will read about the macro pricing picture miss the point. This morning, actually, at the end of my corporate finance class, somebody came up to me and said, I was in an interview this morning, and the interviewer asked, what would happen to stock prices if interest rates went down? And I said, how dumb did the interviewer look? Because every interview is a joint test of both whether your answer is right and whether your interviewer is particularly bright. Because if you give a really good answer to a really dumb guy, bad choice. So I said, because he's really dumb, here's the answer you should give. Of course stock prices will go up, right? Because you hold everything else constant, you bring interest rates down, that's lower discount rates, higher value. But if you have any sense of nuance, you can see that it's almost impossible to answer that question unless you tell me why interest rates went down. I tell them about September through November of 2008. You know what happened to interest rates? They collapsed. That should be great for stocks, right? The only reason is it wasn't great is they collapsed because there was an economic crisis which was devastating to the expected cash flows. So remember those connections, because the more you can think about those connections, it's not like you're trying to outsmart yourself, but you can't keep one thing fixed and change the other things without expecting some shifts as you go along. Any questions? Joseph?
Sorry, what's the intuition behind the interest rate rising and the ERP going down?
Well, what's ERP? It's a difference between the internal rate of return on your stocks and the T-bond rate, right? So if nothing else, the math alone. In fact, you should have been surprised that it didn't go down, because if I increase the interest rates by 2%, you should expect the equity risk premium to decrease by almost 2%. The reason it doesn't is because I get you that little bonus. Higher interest rates usually lead to higher growth. Right? So let's go back to where we were. I think we were on slide 60. It's been almost a lifetime since we were looking at this. Oh, incidentally, I know I keep posting valuations of the week. Somebody once told me that this class is like drinking out of a hose, because I just throw stuff, do this, do that. I don't expect anybody to do everything I kind of dump out there. But pick your poison. Pick something that you'd like to do outside of the class. And yesterday I posted the evaluation of the week. It was actually a very seldom repeat evaluation from last year. But this was actually the valuation I put up in February 2014 when Time Warner and Comcast announced their merger. And it's a spreadsheet designed to value the synergy in that merger. The reason I posted it is, if you've been tracking that merger, it's in big trouble right now. What looked like a sure thing a year ago is not looking as sure anymore. It looks like it might come apart at the seams. Playing with that spreadsheet will give you a sense of what's changed between last year and this year that might actually mean that these companies might actually be happy to walk away from this deal. So take a look at it when you get a chance. So let's set up the process. An implied equity risk premium is based on what you paid today and your expectations of future cash flows. The first thing that makes it different from a historical premium is it's forward-looking. And it's dynamic. Every time those numbers change, as you saw, your equity risk premium is going to change. So I'm going to take you back a long time to January 2008, pre-crisis, and show you what the equity risk premium looked like then. So at the start of 2008, the S&P 500 was at 1468.36. So now it's at 2100. So kind of keep tabs on these numbers as we go along. Unfortunately, with stocks, unlike a bond, I don't know what the cash flows will be for the next 5 years and the next 10 years. But I do know what the cash flows were last year. And cash flows, if you think about investing in all of stocks, take two forms. They can take the form of dividends, and they can take the form of buybacks. The easiest way to think about it is act like you're so rich that you can buy the entire S&P 500. It's all yours. Then all the buybacks come to you. All the dividends come to you. They're the collective cash flows. In between 2001 and 2007, those cash flows average 4.02% of the index. So I know what you paid. I know what the cash flows used to look like. I made the assumption that those cash flows would continue at that 4.02% of the index for the next 5 years. I also threw in a growth rate, which I did not estimate, but I got from looking at analysts. Given how much I mistrust analysts, this might surprise you, but there's a reason why I'm using an analyst estimate of growth. What am I trying to estimate? What is the market demanding as an equity risk premium? To do that, I have to use the market's estimates of growth. Whether they're right or not is not the issue. That's what's driving the pricing. So here's what I have. I have what you paid, 1468.36. 4.02% of that is 59.03. Think of that as your base year cash flow. That grows out at 5% a year for the next 5 years. And I'm getting increasingly uncomfortable doing this over time because these are the 500 largest market cap companies. And to assume that they can grow cash flows at a rate higher than the economy is a dangerous thing. It's the end of the fifth year. I turn the faucet off. I said, beyond year 5, I'm going to assume the cash flows grow at the same rate as the economy in perpetuity, which raises a measurement question. How do you come up with the growth rate in the economy 5 years out? So here I cheated. Remember the graph I showed you about the T-bond rate versus nominal growth? I'm going to draw on that graph, and beyond year 5, I'm going to set the growth rate equal to the risk-free rate. So it's kind of self-correcting. The risk-free rate is too low, the growth rate will also be low. So it allows me to kind of keep the valuation at least in sync. So here's what the equation looks like. There's what you paid, the expected cash flows for the next 5 years. There's my cash flows beyond year 5 going at 4.02%. What am I solving for? I'm solving for that discount rate that makes the present value of my cash flows equal to the level of the index. It's a little messier than a typical IRR calculation because the last term in the equation is not a fixed number. It's going to change as that's why I use the solver function in Excel. And I solve for that R, I come up with 8.39%. You're saying, what does that even mean? Start of 2008, if you bought US stocks, I don't care what you hoped you would make, what you prayed you would make, what you thought you would make. Given what you paid for those stocks, you can expect to make 8.39%. You subtract out the risk-free rate, the equity risk premium on that day is 4.37%. Now, as I said, I put this out every month, and I do get questions from people, and some of these questions are well thought through, but sometimes they miss where the number is. So one of the common questions I get about this is you're capturing the dividends, but when I buy stocks, I buy them for the price appreciation. Where is the price appreciation in this equation? Do you see what the question is? Where is the price appreciation in this equation? See this last term, what is that? It looks like a mathematical equation, but what am I estimating? That's the value of the index 5 years out based on a perpetuity. That is your price appreciation. It's built into that last number. It's already there, just captured through that present value equation. At the start of 2008, the equity risk premium was 4.37%. Until 2008, I used to compute the equity risk premium once every year. At the start of the year, I'd use it for the rest of the year. You know what my defense was? It's a US, it's a mature market. How much can an equity risk premium change during the course of a year? That's emerging markets where they jump around. That was my defense at the start of 2008. It was my defense in January, February, March, April, May, June, July, August of 2008. Start of September of 2008 was still my defense. But I'll jump this page. But between September of 2008 and December of 2009, that defense very quickly came apart at the seams, right? Because that was a price of risk crisis. What I mean by that is in those 3.5 months, markets were changing their mind about how much to price risk at. In fact, by the start of 2009, when I did this equity risk premium, remember the equity risk premium was 4.37% at the start of 2008. At the start of 2009, when I redid this, notice what the S&P 500 is at then? Don't you wish you'd bought the S&P 500 on January 1st of 2009? 903, it's now at 2100. Okay? But wishes and regrets are not going to get you the money back, right? The index had collapsed. The equity risk premium jumped. It jumped for two reasons. One is the index collapsed. You see the other reason? What else changed? The risk-free rate was 4.02%. Because of the crisis, it dropped to 2.21%. So stocks dropped, T-bond rates dropped, the equity risk premium climbed. If I told you the equity risk premium went up a lot in 2008, you wouldn't have been surprised, right? That's the essence of a crisis. And in fact, what I did was, starting September 12th of 2008, I tortured myself. Every morning as I was coming into work, I'd compute the implied equity risk premium that day. Every day for 37 days or for, whatever the number of trading days was. You start September 12th of 2008 at about 4.4%, which is where we started the year at. So not much had changed. That was, of course, the weekend before the Lehman collapse, and then the world came apart. So what you see there in the red line is the S&P 500. In the green line is the implied premium by day. Starts at 4.37%. There was a day in November. It's a very bad day. It was a day in which the Dow was down, I think, 1,200 points. In the last 1 hour. It wasn't even during the course of the day. It just collapsed in the last hour. Nobody would buy. The equity risk premium hit 8%. I was forever cured of the disease of thinking that in a mature market the price of risk would not change quickly. All I need to do is look at this graph and say, never again. That's why starting in September of 2008, I started going monthly. I hope and pray I don't have to go weekly, because that'll mean the market's coming apart even more at the seams. But essentially it shows you how much equity risk premiums can change. And that's why that crisis was so scary. This was supposed to happen in Argentina or Venezuela or Indonesia. Not supposed to happen in mature markets. But you can see how much the price of risk can change during a crisis. Any questions? Yes?
Going back to what you were saying about analyst forecasts,
Yeah.
do you generally use consensus? Or do you
Actually, there are two things, remember, but there are two ways to get the growth for the S&P 500. One is the bottom up, which is to take individual companies, get the growth rates analysts are projecting for individual companies, and take an average. I never use that because it's going to be biased upwards. It's biased upwards dramatically, partly because analysts are biased, and partly because analysts don't have a macro view, so they tend to get focused on their company, they forget the rest of the world even exists, and they can give. I use what I call top-down forecasts, which are forecasts made by analysts who actually track the aggregate earnings for the S&P 500. There are people like Ed Yardeni, who has he publishes. There are about 12 or 15 people who do that, whose job it is to track the earnings. So the first thing, it's a consensus, but there aren't that many analysts, and they track the entire earnings for the S&P 500. And that number is about half what you will see as the bottom up. So if you go into Yahoo Finance and you type in the symbol for your company, and look at estimates, they'll actually give you an estimate for the S&P 500. You can pick any company you want. There'll be an estimate. That is actually a bottom-up estimate, and it'll give you numbers like 11, 12, 15, 18% growth because it's the average across the S&P 500 companies. So my estimate is a top-down estimate, and the reason you have to use a top-down estimate is the second reason analyst estimates are pushed up is if you have a lot of buybacks because they project growth in earnings per share. You know what that's going to do to your growth rate, right? It'll push up the growth rate because the number of shares decreases. I don't want to do that because that'll be double counting. Because I count the buybacks as cash flows, I want the growth in aggregate earnings. So it's a very delicate dance you got to do because if you use a wrong growth rate, you can end up double counting the buybacks both in the cash flows and in your growth rate. Push it. So this has to be aggregate earnings, and it's better to do it top down. If you go to a Bloomberg and pick any index and you type in EE, earnings estimates, it'll actually give you the aggregate earnings estimate for next year and 2 years out. They don't give you a 5-year estimate, but it's really the first 2 years are all that matter because the analysts beyond year 2 just make up numbers anyway, right? So if you get the first 2 years, you're on a pretty good foundation. Rajiv?
So when the market price is high,
Price of what? Market price of the stocks or market price of risk?
market price of the index.
Okay.
High, all things being equal, the risk premium goes up.
If the cash flows don't go up with the market.
The cash flows don't go up.
If the price of stocks goes up without cash flows increasing, the risk premium
Yeah.
decreases.
So then when I put that in my risk-free rate, discount rate, that's going to give me a lower discount rate, which is going to give me for the individual asset, I'm going to have
Higher value.
a higher value.
Yes, sir.
So, I'm sort of just thinking about the disconnect between, you always talk about sort of price and value. So now when price
My question is,
high,
what's your job? Are you valuing a company? If I came to you and said, should I invest in stocks? You know what you should be looking at? Is the index fairly valued? Is the equity risk premium too low? But if I ask you, should I buy Coca-Cola?
it's relative to the market.
I'm asking you to be market neutral. Because you see why? Because if I let you have a market view, let's say you believe that the market is overvalued, which basically means the equity risk premium is too low. You replace that equity risk premium with what you think is a fair premium. You build that into your valuation and tell me not to buy Coca-Cola.
Tell you not to buy anything.
So what I would say is, if you're a really good analyst that I trust, I'll ask you to give me 2 valuations: one of the index, whether you think it's fairly valued, and one of Coca-Cola, given where the index is today. Because if you mix the two up, then I'm kind of stuck, right? Bullish analysts will find everything good, and bearish analysts will find nothing to be good. It'll have nothing to do with the companies they're looking at. It's more of a market view. Yes.
You alluded to this a moment ago. Why 5 years? Is that
Because
just 5 years?
even 5, you're kind of stretching. I could stop at 2 or 3, right? So it's there's no good reason. I mean, it's 5-year growth rates you can get. 10 years impossible. So beyond 5, you're going to be in no man's land. But in some markets, I actually stop after 2 because I can't even get beyond year 2. So I could actually have 0 years of growth. If I have a mature market where there is no high growth phase, I can just make the growth rate equal to the risk-free rate and do it as a terminal value equation right now. So there's no reason why it has to be 5. Right? Yes?
Can you explain again why in the terminal value calculation your risk-free rate is the growth rate that you're assuming?
I don't know whether you remember that graph I had. I don't know which page it was. Let me go back to this page. Don't worry, I'll pull the graph up because it's useful to remind ourselves. See this graph?
Yeah.
This is a graph of the T-bond rate and the growth rate and inflation rate each year. And the point I made was, you look back over the last 50 years and ask you what the growth rate in the economy is. You could ask an economist and come up with a number, or you can look at the T-bond rate. And for the last 50 years, T-bond rates have beaten economists' forecasts consistently as predictors of growth.
So why does this happen?
Well, think what goes into it. Do you remember the Fisher equation in an interest rate? It's expected inflation plus expected real interest rate. In fact, it's Econ 101. A risk-free rate is supposed to reflect the expected inflation in the economy, and an expected real interest rate is supposed to reflect the expected real growth in the economy. So this is exactly what you should expect to see in any kind of settled market. Of course, if you have a market where strange things are going on, this can break down. But since we're talking about the long term, it becomes a very convenient peg to use to say that's why I'm going to set the growth rate equal to the risk-free rate. Yes?
And then just another question about the terminal value growth rate. We said can't be larger than the growth rate of the U.S.
So now you can replace that with the risk-free rate.
Okay, and then why? So I understand why that's true for like revenues can't grow faster than GDP.
You see,
Why can't
if you let earnings grow at a different rate than revenues, and it's forever. So let's take an example.
your margins go down?
Your margins go to either infinity or zero, right? So once you get to steady state, everything has to grow at that rate, or your income statements are going to start blowing up, your balance sheets are going to start blowing up. You see what I mean? If revenues grow at 3% a year, and earnings grow at 4% a year, and I make them both forever, your margin's going to go to 100%. If revenues grow at 3% a year and earnings grow at only 2% a year, margins are going to go towards 0%. So once you get to steady state, in a sense, you lock everything to grow at the same rate, or things are going to start blowing up on you. So it's the reason I use implied premiums increasingly. I almost never look at historical premiums anymore. Is we live in a world where the price of risk changes every moment of every day. And if you're stuck with a historical premium that doesn't change over the course of a year, you'd have been using that same premium all the way through 2008. You'd be in November of 2008 saying, I'll settle for 4%, in which case you'd find everything to be cheap, right? So there's an argument to be made by asking, is this the right equity risk premium? But don't make it in the context of valuing an individual company. Okay? So here's the January 2015 number. January 2015 is start of this year. S&P 500 is now up at 2,058. Market's gone up. Now, if I told you market went up from 903 at the start of 2009 to 2,058, holding all else constant, your equity risk premium should have collapsed, right? That's a huge jump in the market. I don't know whether you remember what the cash flow was at the start of 2009. Let me go back and show it to you. The cash flow at the start of 2009 was 52.58. You know what the cash flow is now? 114.74. That's why all these people who throw the word bubble around are often missing the point. It's true markets have gone up a lot, and that should scare you. But this is a market that's gone up a lot while cash flows have also more than doubled. So if you want to make a case that markets are overvalued, don't make it with that lazy argument of, hey, it's gone up a lot, therefore it must be overvalued, because you have to show me that it's gone up a lot without cash flows going up, and that's not the case with this market. Cash flows have gone up fairly dramatically, and that's why the equity risk premium has not dropped by that much. In fact, it's much higher than it was at the start of 2008. It's lower than what it was right after the crisis, but not by much. Okay? So those are the dynamics that drive equity risk premiums. To get a sense of history, this is what the implied equity risk premium for the US has looked like since 1960. And this is in response to Rajiv's point, which is you look at the equity risk premium today, 5.78%. One of the questions you got to ask is that a good premium? Is that a large premium? Because that's really asking the same question. Are stocks overvalued, collectively undervalued? So if you want to make the argument that stocks are in a bubble, you got to tell me that the equity risk premium I'm making right now is too low, right? So let's look at 5.78%. Is that a high number? Is that a low number? I don't know how else to answer it but to show you what the premium has looked like over time. And since 1960, this is what the equity risk premium for the S&P 500 has looked like. It's between 3 and 3.5% in the 1960s. Very stable, very, so basically nothing's happening. 1970s, you see the equity risk premium blow through the top. What caused that? What caused equity? First, is that a good thing or a bad thing? If you're an investor in stocks, you see equity risk premiums go up while you're holding stocks. What's happening? The prices are going down. So that's actually the 70s. The Dow's dropping to 750. Markets are collapsing. And what caused that to happen? Why did equity risk premiums explode in the 1970s? Well, there was that oil embargo, but there was an oil embargo that affected it. But Germany didn't see the same premium. This was actually the oil embargo then translating into higher inflation. Higher inflation is deadly for equities. You see that equity risk premium increase, stock prices collapse. That's why the next time you read that Paul Krugman column about let's have a 3% inflation rate, who's going to notice? This is why you have to worry. If you're an investor in equities, that 3% inflation very quickly could become 6% inflation, and that's going to cause stock prices to implode. Right? You're saying, let's keep it controlled at 3%. Nobody's quite figured out how to keep inflation controlled. It's like a genie. Once it's out of the bottle, it's out of the bottle. It takes on a life of its own. Then you get to the 1980s, and you can start to see that one of the great bull markets of all time. The equity risk premium drifts down, down. In fact, by the end of 1999, the equity risk premium in the S&P 500 was 2%. So if this had been January or whatever, February something, 2000, the graph would have ended there, right? Then if I asked you, should you be worried about stocks? You can see why you should have been worried. At a 2% equity risk premium, that is the lowest premium we've ever seen. You could say, well, that's too low a premium. It's the same thing as saying stock prices are too high. That is a bubble. When you have a 2% premium, and look at history and say, we've never had something like that. This is where we are right now. The average implied equity risk premium over the last 55 years has been about 4.1%. Based on where stocks are priced right now, we're earning 5.8%. There are lots of weak links there. You can say, what if this, what if that? You're right. There are lots of reasons to be worried about stocks, and that's always been the case. I've never had a year where I said, no worries about stocks this year. There's always something hanging over your head. But if you have an argument to make about stocks being overvalued, I need to hear more than, hey, stocks are up a lot since 2009, because that's a stating of fact. Any questions? Yes, Rich.
Just on the inflation point,
Yeah.
If inflation goes up but there's no expected change in the real cash flows, why does that still depress the equity valuation?
In fact, if inflation were a constant that you could pass through, it would be completely harmless, right? Because 10% inflation, everything is indexed at 10%. You know what the problem with inflation is? As inflation gets higher, it also becomes more uncertain, more volatile. In other words, a 2% inflation rate stays at an 8% inflation, you can go to 14. Or so what it does, it has this feedback effect on macro risk. So if you're a company deciding to take an investment, I'm not guaranteeing you an 8% inflation. You say it could go to 15 or 2. You know what you end up doing? Not investing. Because if you invest at that 8, and that's the feedback effect that's so deadly, is when inflation goes up, it also brings that real risk with it of that uncertainty then feeding back into investment decisions and cash flow decisions. You're right, I could have high, completely neutral inflation, but it's got to be high and stable. And I can't think of a single country that's managed to master a high and stable inflation policy. Right? Latin American countries used to try in the 80s and 90s. They said, and the way they tried is they used to index everything to inflation to make it seem painless. But then 10% became 100, became 1,000, became 5,000, became 10,000. The whole thing blew up in their faces. So you're right, I could create a scenario where high inflation is completely neutral. But then you'd have to rewrite the tax laws as well in the US, right? You see why? Because taxes, what are you allowed to claim as depreciation? What you originally paid for the asset. So if I want to make inflation truly neutral, I'll have to let you write up otherwise all your old assets are not delivering the same tax benefits. So I can create a world where inflation is neutral, but it has to be a world that I haven't seen yet in terms of the conditions that have to hold. Now here's what I'm going to do. I'm going to talk about how this equity risk premium relates to other things we see out there. Let's start with the risk-free rate. The equity risk premium is over and above the risk-free rate, right? Remember the equity risk premium was about 6% in 1978. It's about 6% now. But here's the difference. In 1978, the risk-free rate was about 11%. So you're earning a 6% premium over 11% risk-free rate. Today, the risk-free rate is 2%. And you're earning a 6% premium over a 2% rate. So while the numbers look the same, you could argue that the equity risk premium today is far higher than it was in 1978 because you're earning 6% over a 2% rate, not 6% over a 10% rate. In fact, that's one of the open questions, is if interest rates go up, should I be adjusting my demands up for equity risk premiums? This week's weekly challenge, if you choose to do it, will actually, I'm just dumping out the data. I have the equity risk premium by year, T-bond rate by year. I want you to use statistics to answer the question. As rates go up, have equity risk premiums gone up in the US? If so, how much? At least based on this graph, there seems to be very little relationship in the US between the level of rates and the equity risk premium. The exception is in the 1970s. The 1970s was a one period where as risk-free rates went up, equity risk premiums went up, and maybe the inflation problem was underlying it. But that's the first what if. Here's the second one. The equity risk premium is the price of risk in the equity market, right? So you guys be the equity market, you've priced risk, it's the equity risk premium. You guys be the corporate bond market. How do you price risk? What do I look at to see what you're pricing risk at? I look at a rating, let's say BAA. I look at the spread you're charging. That is the price of risk in the bond market, right? So the default spread in the bond market is the price of risk in the bond market. The equity risk premium is the price of risk in the equity market. Most of the time, the two should move together, right? Because people in one market are freaking out. People in the other market should also be freaking out. And the good news is, most of the time, that's true. Except when it's not. And those are the periods where very interesting things follow. Let me take an example. For much of history, so basically in this you have two graphs. The blue is the equity risk premium, the implied premium. The black is actually the default spread on a BAA rated bond, a pretty safe bond. You can go to the Federal Reserve site and you can actually get this going back to the 1920s. So this is the default spread on a fixed rating class. So the price of risk in the bond market. Here's the first period I wanted to focus on. Take the 1990s. The default spread is staying pretty much where it was, right? It kind of is moving around. Look at what's happening to the equity risk premium over that period. It's going down and down and down. In fact, by the time you get to 1999, the equity risk premium is 2%, and you're getting a 2% default spread on a BAA rated bond. That's a really safe bond. You're getting exactly the same number. So as an investor, what should you be doing? Start at 2000, you have an allocation judgment, right? I put my portfolio. So if you followed this graph, you should be taking all your money out of stocks and moving them into bonds. I'm not suggesting people actually did this, but just looking at the numbers, you can see that the bond market is giving you a much better risk return. And if you're a CFO, raising money to fund your company, how should you raise money, equity or debt, at the end of 99? You should be issuing shares like the cow, no, until the cows come home. Because you say, hey, these guys are not charging me anything for risk. And that's exactly what you saw in the late 90s. And it had consequences. People raised equity even though they didn't need it. And once they had the cash, they had to do stupid things with it because you have a lot of cash. You can think telecom, you can think technology. I'm not saying it caused that bubble to burst at some point in time, but when you have markets moving in different directions, people are going to do strange things that don't make sense in hindsight, but make complete sense given what you're observing then. The market bursts. Let's move 2 years later. Okay? You have 9/11. And Alan Greenspan wakes up one day and says, I will not let the US economy go into a recession. Talk about the hubris of central bankers. Talk about the Greenspan put, right? What did he do? He essentially pumped up the bond market. And you can see that if you look at 2002 through 2007, what are you seeing? Default spreads dropping like a rock, but equity risk premium staying up there. So at the end of 2007, I said, where's your money? It should have been in bonds. It should have been in stocks. You're saying I would have lost money in the stock market? You wouldn't have lost as much as you lost in the bond market, because in most crises, it's the stock market guys who are to blame. The 2008 crisis had its seeds in the bond market. And if you're a CFO in 2007, guess where you raised money? You borrowed money. In fact, this was the golden age of an LBO, right? You borrow money at these really low rates, and then you invest in equities at at reasonable prices, given reasonable in a relative sense. So when you get disconnects there. But most of the time, when one goes up, the other goes up. Here's a very simplistic way of estimating the equity risk premium. You take this entire time period. Roughly speaking, the equity risk premium has been twice the BAA rated default spread. You want to do equity risk premium in a second? Here's the quickest way to do it. The BAA default spread right now is 2.5%. 2 times 2.5% is 5%. Okay? So you don't like implied premiums? Try that. It's still better than a historical premium because it's coming off a current number. So bond market spreads and equity risk premiums. Question?
Yeah, you were talking about Greenspan, like waking up one day and wanting.
Maybe he woke up over a week. Maybe he was on drugs. I don't know. Whatever it was, you know.
But why did he raise interest rates if he wanted to stop?
When did he raise it? It's after 2001, he did not raise rates.
Oh, he did it. Okay. I heard
That was so basically he essentially pushed the bond market. I mean, you can't push somebody to do stupid things, but he set up the infrastructure where essentially people started to underestimate default risk and say default will not happen because somebody is going to come in and make sure it doesn't happen. Okay? So 2 times the BAA default spread. It's the easiest number in the world to look up. You can go to the Federal Reserve site, find out what it is now. We'll just look it up on online. Any questions on bond default spreads and equity risk premiums? So that's comparing the risk premium in the bond market to the risk premium in the equity market. Any real estate people here? Don't worry, I want to. Okay. Is there a risk premium in the real estate market, a required return? I mean, if you can tell me what real estate investors require as a return, I can back out an equity. A cap rate. And real estate investors act like this is some hugely sophisticated number. You don't get us. We're a cap rate based. You know what a cap rate is? It's an expected return, and it's a way you capitalize earnings, which is really another way of saying that's my cost of equity. You subtract out the risk-free rate from a cap rate. You know what you get? You get a real estate risk premium. So let's bring that into the graph as well. So this graph, here's what you have. You have the equity risk premium. You have the BAA rated default spread, and you have the difference between the cap rate and the risk-free rate as a measure of the equity risk premium or the real estate risk premium. And there's something very strange going on. If you look at the 1980s, what do you see about that premium? It looks like it's negative, right? You're saying that makes no sense. When I took finance for the first time, I was taught about how important it was to diversify into real estate. That was the big asset class you went into, and the rationale was that when financial assets do badly, real estate does well. In the 1970s, real estate was what bailed out people if they had an investment in it. Now do you see why you'll have a if real estate actually moves in the opposite direction as financial assets, what kind of beta does it then have as an investment? It's a negative beta, and the expected return on a negative beta investment should actually be less than the risk-free rate. So while it might look crazy, it's actually what you'd expect if real estate is operating as a diversifying asset class. That's the 1980s. When you get to the 1990s, notice something strange happening. Real estate premiums are starting to look a lot more like financial assets, right? So what happened in the 1990s, in the last 10 years, that's made real estate more like a financial asset?
Like the establishment of REITs?
REITs were 1971, so they were even there before. But everything started to get securitized. 95% of real estate was not securitized in the 80s. And then you start to get Lurinieri at Solomon, and this was a very innovative idea, saying let's start to securitize all these mortgage loans. Good idea, but there are consequences, and this is actually true across asset classes, is when you securitize an asset, it seems to lose some of its regular characteristics and take on the characteristics of financial assets. Shows up in gold. Gold by itself behaves differently from gold mining stocks. But here's the broader problem. In the 1985, you walked in, and I was into my office as a financial advisor. I'd have asked you, well, how much money do you have invested in your home? And if you have a lot of money invested in your home, I'd say you can go invest in stocks because you're going to be diversified. 1985, great advice. Today, you walk into my office and I give you that advice, I should be taken out. I was going to say something terrible about myself, but covered with glue, put feathers on, and made to wander through the town square. Do you see why? Because what does this graph say? That if you invest half your money in real estate and half your money in stocks and bonds, next year is a bad year. It's a bad year for stocks, it's a bad year for bonds, and guess what? It's a bad year for real estate as well. So if you want to diversify, you got to find some other way. And that's something we'll search through this class. It's not the focus of this class. but it's not as easy to diversify as it was. In fact, it's really difficult to diversify. You say, go into a global market, markets all move together. Go to different asset classes all move together. That is one of the bad consequences of securitizing everything, is we've made everything more correlated. And if everything's more correlated, it becomes much more difficult for anybody to diversify the way they used to. Right? So any questions about, so the cap rates, you can actually, I'll send you a link on where you can pull off the cap rates, because you can get them on a monthly basis or a quarterly basis. It's a way of thinking about how do real estate investors think about risk. Incidentally, remember the bubbles in the bond market default spread going down? During that period, if you look at real estate premiums, they also went down. We can call this the real estate bubble if that makes you, but that's essentially what you see when premiums in one market kind of disconnect. Here's a broader point I want to make. We live in a world where there are lots of specialists. You're going to each end up in some area. You're going to be equity, you're going to be in the equity module, or you're going to be US equities, and somebody else is going to be fixed income. And each area has become so big and complex that you tend to specialize only that area. You're saying, so what? You're saying, oh, if this disconnect was so obvious, how come nobody did anything about it? Who's noticing? If you work in the equity, you don't notice the fact that your equity risk premium is not connected to the fixed income, right? And this is actually one reason why the initial wave of macro hedge funds, I thought, had a chance. Because what do you do as a macro hedge fund? You step back and you look across asset classes, you look across countries. If you do it well and you're doing it alone, you're going to be able to find some advantages because people are so insulated from each other. So I think it's a good idea, no matter where you end up, for you to keep that focus on being as what, I mean, so don't end up as just an equities person or a US equities person or a fixed income person. Step back and think across markets, because it's disconnects between markets that offer some of the best opportunities for making money. So I've made this sales pitch about implied premiums for a long time now. People are more willing to listen to me now than they were 5 years ago, 10 years ago. Because their reaction then was, we don't need an implied premium in the US. We have a historical premium, and numbers don't change very much anyway. They can't use the numbers don't change very much anymore because markets do change. So the biggest, the most problematic candidates for the sale pitch are investment banks, because they're really set in their ways. So I'll tell you one thing I've heard when I've tried to make this pitch to investment banks, and you tell me what you think about this. So investment banks, it's often common practice to take a historical premium right out of that data that you saw and use it across the board. And their defense is everybody uses the same premium, so it's going to be okay, right? So let's suppose, today for instance, the implied premium is 5.7%. Let's suppose that every banker in an investment bank is using 8%. They're all using the same number, so you're saying the rules are the same, why should it matter? Will the values they obtain be too low, too high, or can it cut both ways? What are they doing? They're using too high a premium. They're going to come. And the counter I get is, as long as they're low by the same proportion, it's okay, because then we rank them. Is that true though? So if I use too high a premium, am I hurting some types of companies more than others? Let's say growth companies versus mature companies. Who's hurt more by using too high a premium? I hear 50-50. Pushing up the premium increases your discount rate, right? The effect of increasing your discount rate is greater if more of your cash flows are later in the game rather than earlier in the game. So using too high a premium will lead you to find growth companies to be more overvalued. So you're not going to get the same rankings. And using too low a premium will give you the exact opposite. You'll overinvest in growth companies like crazy. And in fact, post-2009 and 10, lots of investment banks which were stuck with old historical premiums ended up overinvesting in growth companies. And it's the sheer math of it. You can almost see it happening. And that's why it's not just enough to say we all use the same premium. If it's the same screwed up premium, you still have a problem. Doesn't mean you have to tweak your premium to be the implied premium at the start of every month, but at least you have to have a sense of how far you're drifting from the implied premium, because the further you drift, the more dangerous this game becomes. Jordan?
If you're using a higher value then?
Well, here's what, if you keep the same cash flows for both growth and income, when I push up the discount rate, so the discount rate goes up, but if your cash flows are front-ended, the effect of having the high, so it's really not even that so the cost of capital goes up for all companies, but the cost of capital goes up, the effect of that increase in cost of capital is greater if you get so if you have negative cash flows up front like Tesla, pushing up the discount rate might actually make it look better because you're discounting the negative cash flows. Whereas if I have a company like Altria, you could get the reverse happening. So
you're going to underinvest in the stable companies or overinvest in the...
Well, it depends on the growth company, right? So if you have negative cash flows, it might not. But if you have small positive growing, so it cuts across companies. It's very difficult to make a judgment across the board. But the only thing you can say is your rankings are going to be different if you use the wrong premium. Okay? So this is, I'm going to pass this pitch to you because you're going to go work in places which are still stuck on using historical premiums. It's not going to be easy to convince people to change because you're asking them to leave a comfort zone. Because for some reason, people think that if a number doesn't change, it's more reliable. It's a strange thing to hold on to. But they're worried about implied premiums because implied premiums change all the time. But that's reality, and you might as well deal with reality rather than be in denial. Now, I've given you different ways of estimating the equity risk premium. You can use historical premiums. You can use implied premium. You can use an average implied premium over time. You can use the default spread-based premium. But ultimately, what's the ultimate test? Which of these premiums is the best predictor of the future, right? Because that's what we're trying to estimate. So what I do every year, and I'll send you the update for this, is I write this paper on equity risk premiums, where I pull all these different approaches. I look at the history. And then as the final part of the paper, I look at which of these ways of estimating the equity risk premium gives me the best estimate for the future, because since that's what I care about. So what you're looking for is a high positive correlation. A high positive correlation means you're getting a good predictor. So if I use the current implied premium, that's a correlation, 0.712. In fact, the current implied premium is the best predictor of the premium next year and the best predictor of the actual returns over the next 10 years. So basically, I take the premium now and I look at so I take the premium in 62, look at the returns from 63 to 72. So it's so I'm saying which one of these numbers. So the average implied premium, not bad. Pretty close to current implied. So if you want to use an average premium because you worry about the numbers changing too much from month to month, okay, you can do that. If I use a historical premium, first notice the sign. The historical premium is a non-starter in this process. It actually moves in the wrong direction. When it asks you to use a high number, you should be using a low number. When it asks you to use a low number, you should be using a high number because it seems to be cutting away from where you want to be. And the default spread premium actually, so if you're stuck with if people will not buy into your implied premium approach, at least sell them on using a default spread times 2. How easy is that, right? It will still do much better than using a historical premium. Any questions at all about equity risk premiums? One final point about implied premiums. Remember the convoluted way in which I came up with country risk premiums last session? Where I took the default spreads and I applied this multiplier factor and then I added onto a mature market premium. It's very messy because I have lots of assumptions built on other assumptions. When I computed an implied equity risk premium for the S&P 500, what did I need? I didn't need any history, right? I needed the level of the index today. I needed the cash flow last year. I needed an expected growth rate, and I solved for the internal rate of return. Can I do that for an emerging market? I don't see why not. In fact, take the Sensex, September of 2007. It's trading at 15,446. One thing that makes implied premiums easier outside the US is you don't have a lot of buybacks, it's all just the dividends. So just add up the dividends. The dividends are about 3% of the index. The expected growth rate next 5 years was a bit of a pain. But I'll tell you what I had to do to cheat to get that, but that was about 14%. And beyond the 5th year, I set the growth rate equal to the risk-free rate because I'm doing everything in Indian rupees. The risk-free rate in Indian rupees was 6 point. I'm following exactly the same rules I do with the S&P 500. There it is, level of the index, expected cash flows, terminal value, solve for R, I get 11.18%. You're saying, what does that mean? September of 2007, if you bought Indian stocks, your expected return based on what you paid for those stocks was 11.18. You subtract out the risk-free rate, you come up with an implied premium of 4.42%. There are two ways you can read that. One is if you're asked to value an Indian stock, because I'll use a 4.42% premium. The other is, remember that table I showed you with all the implied premiums of the countries using my convoluted approach? In September of 2007, that approach would have yielded an equity risk premium of 8% for India. So if you're an asset allocator, you might look at the 4.42% and say, you know what, that's too low for me given the risk in India. So I'm going to invest less in India. So it's an asset allocation mechanism. And if you're a global portfolio manager, I think this is a key part of your toolkit. Estimating implied premiums by country and deciding which countries give you the best trade-off in terms of risk and return. Because once you get these implied returns, then you can say, okay, this country looks good. Given the risk, I'm getting 8% as a premium. This country looks awful. I'm getting a 4% return. And what causes implied premiums to get away from those, if some fair premium, is especially in India and China. We have a problem in how the equity risk premium comes up. Which is, equity risk premium comes from stock prices, right? Demand and supply. And in a market where there are no capital restrictions, if your market is overvalued, what investors do is they take money out of the market and they invest it. So if the implied premium in the US dropped to 2% and the implied premium in Germany was 5%, a lot of money would flow out of the US into Germany. So the mechanism that keeps numbers reasonable is the flow of capital in and out of the market. What's the problem in the Indian market that prevents me from doing that, or the Chinese market? Let's say the Indian market risk premium becomes too low relative to what it should be. All Indians have to do is sell Indian stocks and go buy German stocks, right? But they can't do that. Indian investors are not allowed to invest outside India. There are restrictions on money leaving the country. You can do it in some convoluted way by buying some mutual fund that charges you a huge premium for doing it. You see what this is going to create? Essentially, it keeps money penned in the country, and they have no choice. They're going to have to keep buying equities until even they say, no, this is too low. And what do then? They take the money out of stocks, but because they can't invest it in other countries, what are your choices? You can invest in real estate. You can invest it in gold. You see what how you create the foundations for bubbles all over the place? I mean, both China and India, I think, have real estate bubbles. And I'm saying this as a non-real estate person. The real estate bubbles created because you've taken away those escape valves you need for money to be able to move around. The escape valves are not there. They have to move somewhere else in the economy. So it's almost like it's bubble after bubble. You've got to keep finding a different place to create a bubble. And that's exactly what you would see when you have capital restrictions. You see, but it worked for India and China 30 years ago. Why isn't it working? Not 30 years ago, there was not much money in India and China. So you put restrictions, nobody cared. As both countries have more wealth being generated, this problem is only going to get worse. And the longer you put off dealing with it, the worse the problem is going to be. In fact, China tried, I think, 2 years ago, giving a little escape hatch where they let Chinese investors invest in Hong Kong stocks, and then very quickly they had to start pulling things back because it got out of control. That's something that is going to happen sooner or later because there's too much money chasing too few stocks. And the recipe is disaster. Rajiv?
I mean, but to be fair, it doesn't prevent bubbles in markets.
It doesn't prevent bubbles in other markets, but
Where you have capital moving freely.
okay. Even capital, you're right. And those bubbles are different. They're bubbles that are created by human over-optimism. No. And those are good bubbles. I'll tell you why they're good bubbles. It sounds like a weird thing. So good bubbles are terrible. You know what a world without bubbles would look like? It would be a world run by actuaries. What did they do? They'd work out probabilities. No. That fire thing looks like it's out of control. So let's not start it. We'd be still living in caves with stone tools if actuaries made the decisions. Every bubble has at its core that human capacity to overreach, right? That's what creates bubbles. You overreach, you're over exuberant, but every bubble leaves an imprint that changes the way that .com bubble. Did it change the way we live? It sure changed the way I live. I do everything online. I buy online, I make reservations online, I cancel things online. I eat online. No, actually. No, but it's only a matter of time. Virtual food being delivered to a virtual stomach. Right? But it did change the way we live. The social media, if it's a bubble and it bursts, you're still going to be on Facebook. You'll stop talking to people completely. You'll tweet and Facebook yourself. But it'll change the way we live. That's why I think when people say, I wish we lived in a world without bubbles, I say, be careful what you wish for, because you might get it. This bubble, though, is different. This is not a bubble driven by over-optimism. It's a bubble driven by a restriction on where you can invest. And there's nothing good that comes out of that bubble. Right? So it seems like I'm parsing between bubbles. But if you're going to create a bubble by forcing people to stay in a market, then those bubbles are going to keep happening. And in India, it used to be just gold. People would buy gold, they'd stick it under the bed or wherever, you know. But gold used to be where people, which is a horribly unproductive way for people to invest, right? So that's my only point. Is that you're not going to eliminate bubbles by having free flow of capital, but you definitely will increase the probability of bubbles by not having free flow of capital.
But also comes at cost, because the sort of, I guess the economic development model is export-based in a lot of developing markets, for which the cost of having a volatile exchange rate, which is what...
But having a captive local investor audience also has a cost, right? Because if you drive the premium too low,
Sure, it's not a one-way
but if I drive the premium too low, what happens to foreign investors looking at that market? They're going to look at the market and say, I'm not investing at the 3% premium you guys are investing in. So it's not even clear to me that you actually increase the capital available to your own firms by doing what you're doing. So if the argument is by doing this we increase the capital available, so this has nothing to do with exports and imports. This has to do with capital invested in where it's invested. And the question is, if I open the markets up, will Indian companies actually have less access to capital? And I don't think so. I think actually they will change the access. It will be a different kind of access, and maybe they don't want that. Maybe Indian companies actually prefer local investors where they can essentially do the corporate governance they do and get away with it, because their response is, where the heck are you guys going to go? Right? So I think there are all kinds of agendas playing in here, but the problem is just getting too big. It's going to kind of explode on somebody sooner or later. Yeah.
Are you saying that only if they remove the regulation, then the equity bubble will burst?
Well, I'm saying that if they remove the regulation, then money is going to start finding other places to invest, which means somebody's going to lose and somebody else is going to win. It might be real estate in Mumbai that collapses first, right? Because the money is going to come. But I think what we have now is an artificially, it's kind of a constrained market. So the prices you're observing for real estate in Pune or Chennai might not reflect the fair price, even, because these are people who are investing there because they think they have no choice, or they really have no choice. So there are going to be all kinds of adjustments, some good, some bad, some are going to gain and some are going to lose. So it's not going to be all losers and all winners. It's going to be a mixed effect. Now, actually, I've been going to Brazil every year since 1997, and every year that I go to Brazil, I've been computing the implied premium in Brazil. And this graph actually shows you how Brazil has changed while I've been going there. When I went in 97 to Brazil, it was a really risky country. It was coming off, hyperinflation. People were just terrified. I still remember the first valuation seminar I ran in Brazil. It was a 2-day seminar. Every question I was asked was about inflation. Return on capital, I don't care. Let's talk about inflation. That's a very, very unhealthy place for investors to be when all people talk about is inflation and nobody's talking about companies and how to manage them and how to run them well. Implied premium reflects a huge premium relative to the US. As you go through much of the last decade, it's been a good news story for Brazil. You see what I mean by a good news story? The gap between the Brazilian implied equity risk premium and the US equity risk premium has been shrinking. And you saw that happen in Brazil in terms of the economy changing. In the last couple of years, you've started to see that implied premium go up again, partly for political reasons, partly for others. So I'll keep watching, because I think this is an interesting way in which you can keep track of how does the rest of the world view a country by just looking at the differential equity risk premium. And final point about equity risk premiums. Okay. I actually, for about 2 years ago, when emerging markets went through a bit of a funk, and people were saying, well, this is terrible, emerging markets are collapsing, I decided to take a closer look at the implied premiums in emerging and developed markets. So basically what I did was I took the price to book ratio at which markets trade. I backed out the cost of equity and took the difference. So the way to read this is, see, take these the second and last and third to last columns. That is like an implied premium, implied cost of equity. So in 2004, the implied dollar cost of equity for developed markets was 7.27%, for emerging markets was 10.62%. The market was charging at 3.36% collectively for emerging markets. See, that makes sense. They're riskier. Take a look at that number as you go through 2008. It jumps back up again. 2008 through 2012. You look at that premium. The number is almost going towards zero. At the end of 2012, markets were actually pricing investors were pricing emerging markets collectively at almost the same cost of equity as developed markets. And you could tell stories about how emerging markets were getting safer, developed markets were getting riskier. But let's face it, at the end of 2012, if you told me that there was no difference between investing in Germany and investing in Southeast Asia, I'd have called you crazy. But that's what markets were saying. Don't worry, they're all converging. What you saw as a correction in 2013 was actually the premium going back up towards 0.71%, which is actually lower than it was pre-2008. But you have 3 steps forward, 2 steps back. Nothing is ever linear in markets. So it might be true that emerging markets are getting safer, but they still have pockets of uncertainty that are not going to disappear just because we all wake up one day and say emerging markets are safe. So this is actually an interesting way to kind of track how developed markets and emerging markets are moving to see if in fact there is a collective mispricing. So what I'd like to at least get started on next. So we've talked about risk-free rates, we've talked about equity risk premiums. Any questions on either of those? Let's talk about measuring relative risk. Notice I didn't say measuring beta. Beta is one way you can measure relative risk, but basically I want to know how risky your stock is relative to the average stock. So just to show you how open-minded I am about this, I'm going to give you 12 different ways of measuring relative risk, and you can take your poison and live with it, or die with it, or whatever it is. First is what I call my modern portfolio theory quadrant, which is the classic CAPM beta. You can use arbitrage pricing models or multi-factor models. You can use a sector average beta, bottom-up beta. Those are all in the modern portfolio theory quadrant. So if you're in a finance class, you're probably stuck in that quadrant. I'm going to open up the process. Maybe you don't trust these modern portfolio theory measures, which are all based on covariances and correlations with the market. Look at market risk versus firm specific. Maybe you've never bought into that. So here's the second quadrant. It's entirely stock price based. You can take the variance in stock prices, not just the beta, but just how and use that as your measure of risk. You can take the cost of debt, which you can observe for a firm, and have some kind of scaling variable. So if your cost of debt is 6%, you can then multiply by 2 and say my cost of equity is always twice my cost of debt. You can use an implied cost of equity. You say, what the heck is that? How did I get the implied required return for the S&P 500? I took the index today, took the cash flows, and I backed out. I could do the same thing for individual stocks, right? I could take the IBM stock price today, expected cash flows. It kind of reverses my DCF approach to come up with an IRR. I could then come up with an implied cost of equity for companies within a sector. CFROI, which was widely used for a while in valuation, that's how they used to get costs of capitals. Rather than work from the bottom up, they'd work out the implied cost of equity in capital. Let's say you don't like either stock prices or modern portfolio theory. I have a third choice. I call this my intrinsic risk quadrant. So if you're stuck in a Ben Graham, Warren Buffett world, maybe this might appeal to you. So you could use some proxy for risk. It could be market cap. It could be something that you say is much better measure of risk. It could be a composite measure, quantitative and qualitative factors. So for instance, Value Line has this risk class. They break from 1 to 5. Don't ask me how they come up to 1 to 5, but it's based on what they say are quantitative and qualitative factors. How good is the management? How reliable are they? You could base it on balance sheet numbers. You could say, look, I'm going to look at book value debt ratios. If it's lower, a company is safer. If it's higher, a company is riskier. Those are intrinsic value measures. Or you can use accounting earnings based measures of risk. In all of those, all I want at the end is a number that looks like a beta, right? So if you use debt ratios and you come up with a number, it's a 1.2, I can live with that. So if you don't like CAPM betas, don't throw the baby out with the bathwater. Don't Just abandon DCF valuation, because you can use any of the other approaches, and as long as you replace the beta with something that measures relative risk, you're going to come up with the cost of equity. So let's talk about the CAPM beta. The way I was taught betas and the way you might have been taught betas is probably exactly the same. I was asked to run a regression of returns in the stock against returns in the market index, and I was told the slope of the line is the beta. Horrible advice. Because a regression beta has three very, very bad problems. The first is that beta comes with a big standard error. In other words, it's a statistical slope. And if you remember your statistics, whenever I have a slope, I have a standard error associated with it. And a regression beta, a single regression beta, is always going to come with a lot of noise. Second, by definition, a regression beta is backward looking, right? Do you know what I mean by backward looking? If I ask you to estimate the beta for HP, you're going to take the last 3 years, you're going to run a regression. Problem is, HP looking forward is going to be a very different company. It's going to be two different companies. It's backward looking. And third, you're stuck on past prices, right? So if I asked you to estimate the beta for Snapchat, there's a news story today that Snapchat's raising, what, 450 million or something. You say, I'm going to go look up the beta for Snapchat on Bloomberg. Good luck to you. You're not going to find it because it's not traded. So you will never be able to value a private company or a company for an IPO. So let me back this up. Here's the noise problem. Later in the semester, I'm going to value Amazon. In early 2000, just to kind of frame what it looked like then. And I need a beta to do the valuation. I went into Bloomberg and I looked up a regression beta and I came up with a number. It's 2.23. That's good, right? Raw beta. Then I took a look at the standard error of the beta. And it said 0.50. So read that for me. What does that even mean? That your regression beta is 2.2, your standard error is 0.5. If I ask you for a range on Amazon's beta, it's going to be anywhere from 1.2 to 3.2. Fat lot of good that does you. That's a noise problem. Okay? And of course, I could make that noise go away by playing around. This is a great looking beta. It's one of the favorite betas of all time, the beta for Nokia. Every point is on the line, look. R squared is like 100%. If this were a statistics class, this is great. This is exactly what you want to see. But then if you take a look at why it's such a good looking regression, do you see why? Why is Nokia looking so good on a beta basis? What is it being regressed against? The hex. I didn't even know there was an index called the hex. So the witch's curse until I ran the regression. That's a Helsinki exchange.
It's the only mega cap
In early 2000, I had no idea what was in the Helsinki Stock Exchange. It may be revealing of my ignorance. So I went and looked, and I wish I hadn't. In early 2000, Nokia was 80%, 80% of the hex. See what I have here? I have a regression of Nokia against Nokia. Awful lot of the time, the two move together. Surprise. It is a completely and totally useless regression. And I'm going to say, almost most European companies have this problem because the way Bloomberg runs regressions, and most services do, is they're parochial. You ask for a beta for Siemens, it runs it against the DAX. The problem is the DAX is only 30 stocks, Siemens is 7%. So you might not get the Nokia level problem, but you're getting versions of the problem with almost every large European company. The betas are completely and totally meaningless. So you're saying, what do I do then? Let me give you some suggestions. You could try to play with the regression beta. Don't take the suggestion. It's a horrible suggestion, but you could sit there in front of the Bloomberg. Try it though. It's fun. Change the index. Change the starting point and the ending point. Change from weekly to monthly. You will discover how powerful you are. You can make the beta of this company go from 0.5 to 2.2 to 1.6, and you will learn a very important skill, which is at some point in time in the future, if you have to come up with a beta for a company and reverse engineer it, all you need is access to a Bloomberg in about 25 minutes. And you can come out with a printed page that looks very official. Look, beta is 1.13. Completely and totally playing with the numbers. You can estimate the beta for the company instead of using this, the unstable number in the beta is that covariance number, the correlation number. So one way to get around that is to just take the standard deviation of the stock and divide by the average standard deviation across all stocks. So as an example, if GE has a standard deviation of 18% and the average standard deviation across all stocks is 25%, 18 divided by 25 gives me 0.72. Looks a lot like a beta, right? I'll use it instead. I'm actually going to argue that both those choices are bad ones, and that the best way, if you're going to stick with estimating beta for a company, the CAPM sense, is to estimate a beta by, I'm going to call it a bottom-up beta. It's going to look fancy, but it's really a beta built up by looking at what businesses you're in as a company. But all of these approaches, I'm staying within the CAPM beta. You're saying, what if I don't want to use a CAPM beta? Let me give you some suggestions. Go with the measure of accounting risk. So if you can come up with a ratio in accounting, and you picked it. I mean, I wasn't the one. So if you want to go accounting, it's your choice. You have to tell me what number in accounting you will then use as your measure of risk. So I know people who use debt ratios. High debt ratio means you're risky. Low debt ratios mean you're safe. So if you have a 30% debt ratio, and the average company in the market has a 45% debt ratio, you divide 30 by 45, and you say, looks like a beta, 0.67. You can also use accounting earnings volatility. Look at the variance in earnings. In fact, I compute that for every company, take 10 years of earnings. And then you can compare your accounting earnings variance to the variance across the market. Essentially, you're trying to come up with something that looks like a beta using accounting numbers. In the proxy models, which Pharma and French came up in the 90s, you tell me whether you're a small cap company or a large cap company. Low price to book or high price to book. I plug it into a regression equation. I have a cost of equity. Okay. If you want to be qualitative about your risk, I don't particularly like handing over this power to you. But if you say my strength is I can look at a management and tell you when there's a lot of risk, hey, to the degree that you buy into your capacity to do that, then come up with a way of quantifying that qualitative factor, and I'll make it look like a beta. Essentially what I'm saying is you come up with your way of measuring risk. I'll convert it into something that looks like a beta and keep moving. One final approach, and this is something that that showed up in the Harvard Business Review as a suggestion for cost of equity. They said the cost of debt is observable. Is that true? If you have bonds outstanding, it is. So let's say you take those companies. So if let's say you have debt outstanding and the interest rate on your debt is 6%. Here's the way the paper went. And it's actually, the logic is not bad. They said if it's costing you 6% to borrow money, your cost of equity must be higher. Does it make sense? Then they look up two numbers. They looked up the standard deviation of the corporate bond and the standard deviation of the stock price. This is very similar to what we did with the country default spreads. And they take that ratio. And they scale up the cost of debt to get to a cost of equity. Actually, I don't have a problem with this approach. If this is the way we want it, the only problem is it works for what kinds of companies? Companies that have a lot of debt that's publicly traded. And those are not the companies we usually have trouble estimating cost of capital for, right? I try this on a Twitter. It's not going to work because there are no bonds and I can't come up with a cost of debt. Then I'm kind of stuck. But again, if that's the way you want to estimate cost of equity, go ahead and do it because, as I said, it's a means to an end. It's not the end. Final point, and then we'll talk about more about this next week. When we think about betas, we tend to think about numbers and we tend to think about regressions. But the beta for a company comes from choices you make as a company about what business to be in, your cost structure as a company, fixed costs and variable costs, and how much you borrow. So next session when we start off, we're going to start with that opening. We're going to say betas are not regression numbers. They're not slopes of lines. They measure decisions you make as a company. And we'll use that as a foundation for estimating betas and cost of equity. Okay? So I'll see you on Monday.